We've seen versions of this before, though never with today's global demand profile. In past crises, precious metals markets experienced sharp dislocations between futures and physical pricing. Coins vanished, premiums exploded. Eventually things normalized, but only after policy responses, liquidity injections, and time. The difference now is the scale of industrial demand layered on top of investment demand. Global mine supply is substantial, but not wildly elastic. Industrial uses consume the majority of annual production, leaving a smaller slice for investors. When investment appetite surges at the same time that supply chains are tight and above-ground inventories are already drawn down, the buffer disappears. That's when price behavior changes character. In well-supplied markets, higher prices coax out more supply and dampen demand. In tight physical markets with critical industrial uses, higher prices don't quickly solve the problem. A manufacturer can't just skip silver if it's essential to their product. They pay up or risk shutting down production lines that cost far more than the metal itself. Meanwhile, the futures market still sets the reference price most of the world uses. Dealers quote spot plus premium. Refiners price contracts off exchange benchmarks. That system works as long as futures remain a credible proxy for physical reality. If participants begin to believe that large volumes of paper claims represent metal that can all be delivered, confidence in that benchmark erodes. When a benchmark loses credibility, markets look elsewhere. Regional exchanges with stronger links to physical settlement gain influence. Bilateral contracts priced off real transactions gain weight. The global anchor price can shift, sometimes abruptly. That transition is rarely smooth, and it's often accompanied by extreme volatility as old assumptions unwind. Some argue that prices have been artificially restrained for years through heavy use of short futures positions. Others counter that futures markets are simply efficient hedging venues. The truth is probably less cinematic than either side claims, but perception matters. If enough participants decide the old price no longer reflects reality, behavior changes first, and explanations come later. Volatility then becomes the norm rather than the exception. $10 intraday swings stop being shocking. Exchanges raise margin requirements, forcing highly leveraged traders to reduce positions. That can cause sharp pullbacks, but if underlying physical demand remains strong, dips get bought quickly. The market turns into a tug-of-war between financial deleveraging and real-world consumption. It's also worth remembering that not all buyers are speculators chasing charts. Some are governments, large institutions, and corporations securing long-term supply. They're less sensitive to short-term price noise and more focused on strategic positioning. When that kind of buyer steps in, traditional technical signals lose some of their predictive power. None of this guarantees a straight line higher. Markets breathe. They spike, correct, and spike again. But when structural supply constraints, geopolitical stockpiling, financial stress, and industrial necessity all line up, price can move in ways that feel irrational until you zoom out. The key takeaway isn't blind panic. It's understanding that the number on a screen is a financial construct influenced by leverage, sentiment, and liquidity. The bar in a vault is a physical object influenced by mining output, refining capacity, transportation, and policy. Most of the time, those worlds overlap neatly. Sometimes they drift apart. When they do, access matters as much as price. Owning something that S hard to source can feel very different from owning something that S merely expensive. If the gap between paper and physical keeps widening, the conversation shifts from is it cheap to can you get it at all? And that's when markets stop being abstract charts and start becoming very real, very fast. Let's fast forward to the moment nobody rings a bell for. It won't start with sirens or a dramatic headline. It'll be a bland press release buried on a website at 6:42 a.m. A refiner, a dealer, maybe a bank, calmly explaining that due to temporary disruptions, they're unable to meet certain delivery obligations. They'll blame logistics, weather, labor issues, spin the wheel, pick a reason. What they won, T say, is the only part that matters. They don't have the metal. That's how these things break. Quietly at first, then all at once. Once one counterparty fails to deliver, trust evaporates fast. Every buyer who thought they had metal coming starts demanding proof, not promises. Every contract gets questioned. Every warehouse receipt gets a second look. The paper market, which runs beautifully on confidence, starts to wobble the moment confidence cracks. We've seen versions of this pattern before across commodities. Tin in the 1980s, palladium around the turn of the millennium, rhodium during its wild runs, nickel more recently. The script rhymes. Heavy use of derivatives keeps prices tame on paper, physical supply tightens underneath, volatility spikes, margin calls fly, and eventually someone can't perform. When the dust settles, the new normal price isn't a little higher. It's multiples higher because the market has to jump to a level that actually balances real supply with real demand. Here's the uncomfortable thought. What if the first big price gap isn't T, the finale, just the opening act? Markets that have been financially engineered for years don't always adjust in polite linear steps. Sometimes they lurch. If a long suppressed price finally starts reflecting scarcity, the move can overshoot anything that looks reasonable on last year's chart. That's where the conversation shifts from trading to access. In an orderly market, you argue about whether something is 10% overvalued or 15% undervalued. In a disorderly market, the question becomes whether you can get it at all. Reference prices lose meaning if delivery mechanisms are strained and exchanges are halting trade to cool tempers. Now add politics to the mix. When essential industrial inputs spike in price, governments get nervous. Silver isn't just a shiny collectible, it's embedded in electronics, solar panels, medical applications, and more. If prices run far enough, manufacturers feel it. If manufacturers feel it, politicians hear about it. And when politicians feel cornered, they have a long history of changing rules in the name of stability. The U.S. gold policies of the 1930s are the classic example people cite. Different metal, different era, different monetary system, but the lesson that governments will intervene in critical markets during crises is very real. That doesn't mean history repeats tick for tick, but it does mean policy risk isn't imaginary when financial stress and strategic materials collide. This is why extreme scenarios tend to cluster. Financial strain in banks, stress in funding markets, volatility in commodities. They're not isolated storms. They're often different clouds in the same weather system. When liquidity tightens, leverage positions everywhere become harder to maintain. If large institutions are caught on the wrong side of a fast move, they need cash yesterday, not next quarter. That's where funding markets come in. Big banks constantly borrow and lend short-term cash, often using government bonds as collateral. These markets are usually boring by design. When usage spikes or strains appear, it's a sign that cash is more precious than usual. If the same institutions active in those funding markets also carry large derivatives exposures, stress can travel quickly from one corner of finance to another. Imagine a bank that's short a commodity through derivatives while also relying heavily on short-term funding. If the commodity price jumps sharply, its margin requirements rise. To meet those calls, it needs cash. If funding markets are already tight, finding that cash gets harder and more expensive. Multiply that dynamic across several players, and you have the makings of a feedback loop no one ordered. In that environment, exchanges and regulators face ugly choices. Let prices run and risk institutional failures, or step in with trading halts, higher margins, and emergency measures. None of those tools create new metal in a vault. They just redistribute time and pain. For investors, the biggest misconception in moments like this is thinking purely in terms of profit. Yes, big price moves create opportunities, but they also create operational risk. Brokerages can change margin rules overnight. Trading can be paused. Products that normally track prices neatly can decouple. The plumbing matters as much as the prediction. Physical ownership has different trade-offs. It removes some counterparty exposure, but introduces storage, security, and liquidity considerations. It's not as simple as paper bad, metal good. It's about understanding which risks you're choosing. In calm times, those distinctions feel academic. In stress times, they feel very practical. Another point often missed in the hype is that parabolic markets are emotionally brutal. The same volatility that creates life-changing gains can also produce stomach-churning drawdowns. $10 or $20 swings in a day stop being shocking and start being routine. Leverage that looked sensible in a quiet market becomes a demolition charge in a fast one. If a true supply squeeze unfolds, margin requirements will likely rise repeatedly. That forces leverage traders to either add cash or reduce positions. Some will be forced sellers into strength, creating sharp pullbacks that confuse anyone expecting a straight vertical line. Meanwhile, end users who actually need material may keep buying dips simply because their factories don't run on chart patterns. Over time, if physical tightness persists, pricing power can migrate away from purely financial venues toward markets and contracts more closely tied to actual delivery. That transition can be messy and politically charged, especially if it exposes past assumptions about available inventory as overly optimistic. The most important mindset in all this is flexibility. Strong narratives, on both the bullish and bearish sides, tend to sound smartest right before markets humble everyone. It's possible for prices to overshoot, undershoot, spike, crash, and spike, again all within a broader structural shift. Surviving that kind of environment is less about calling the exact top or bottom and more about not getting knocked out of the game. So if you're watching these developments, think in layers. There's the macro layer of liquidity and credit. There's the industrial layer of real-world demand. There's the financial layer of derivatives and leverage. And there's the policy layer where rule changes can alter outcomes overnight. They interact sometimes gently, sometimes like bumper cars. Big repricings, when they happen, are rarely polite re-ratings. They're more like elevator cables snapping, fast, scary, and unforgettable for the people inside. The goal isn't to panic or to assume the most extreme outcome is guaranteed. It thus has to recognize that markets built on confidence and leverage can change character quickly when the underlying constraints get tight enough. And when that shift comes, the difference between a theoretical price on a screen and the real cost of securing something tangible can become very, very real. You probably thought it was just another routine morning. Coffee, inbox, quick glance at markets. Then that harmless little email from your bullion dealer. Temporary supply delay. Mildly annoying, sure, but nothing dramatic. Silver's sitting at $28. You think it looks cheap. You try to buy a few coins, and suddenly everything insists out of stock, so with a 4-6 week wait. You shrug and move on. That quiet moment right there, that's the scene of the crime. The problem is, the victim isn't obvious, and the weapon doesn't leave fingerprints. What you ran into isn't a shipping hiccup or a mint taking a long lunch. It is a liquidity event, one that S hitting the physical silver market behind the curtain while the paper price smiles politely on your screen. The financial headlines aren't screaming about it. Business TV is busy chatting about stock rotations and AI earnings. Meanwhile, something far less photogenic but far more important is seizing up, the credit plumbing that keeps physical metal moving. Here's the part most retail buyers never see. When you order a silver coin from a major dealer, you assume you are buying from a pile of inventory sitting in a vault with your name about to be taped on the box. In reality, you're often buying from a credit facility. The modern bullion pipeline runs on borrowed money. Dealers and wholesalers use revolving bank lines to finance metal in transit and in storage. It's standard commodity finance, efficient, scalable, and perfectly fine. Until the banks get nervous. Picture a wholesaler with a $50 million credit line. At current prices, that supports well over 1 million ounces of silver inventory. That metal flows from refiners to vaults to retailers, greased by short-term borrowing and hedged in futures markets to manage price swings. Customers buy, cash comes in, loans get repaid, and the cycle spins again. It's not glamorous, but it works. Now imagine the bank quietly trims that credit line by 40 or 50%. Same company, same demand. Half the financing. Instantly, the amount of metal they can carry shrinks, not because silver disappeared, but because the money that moves it did. The refiner still has bars. The vault still has space. The trucks still run. But fewer ounces get purchased and pushed downstream because fewer ounces can be financed. Multiply that across multiple dealers and wholesalers, and you get what looks, from the outside, like a supply shortage. Websites flash, delayed. Popular coins vanish. Delivery windows stretch. Customers think, wow, silver must be getting rare. In reality, it's getting harder to fund. Why are banks pulling back? Because they're hoarding liquidity. Higher rates, volatile bond markets, pressure in commercial real estate, deposit competition, none of that makes lenders eager to extend low-margin credit to commodity dealers. From a banker's chair, parking cash and short-term government instruments can look a lot more comfortable than financing truckloads of shiny metal. So credit gets repriced, collateral demands rise, and some facilities simply don't get renewed. Here's where things get counterintuitive. When dealers lose access to financing, they don't just stop buying. They often have to sell what they already hold to free up cash. And to manage price risk while doing that, they use futures markets. That hedging and liquidation can push paper prices down even as retail demand for physical product is rising. To the casual observer, the chart says weakness. The coin shop says, sorry, sold out. We've seen this movie before. In March 2020, silver futures plunged while physical premiums exploded. You could see a low spot price online, but actually getting metal anywhere near that number was another story. The disconnect wasn't because people lost interest in silver. It was because the financial system briefly choked, and the parts of the supply chain that relied on credit got squeezed. Today's risk isn't that mines suddenly stop producing or that silver evaporates. It's that the financial lubrication that keeps metal flowing gets sticky. When that happens, price discovery in paper markets can drift away from the reality of sourcing coins and bars. The screen and the street start speaking different dialects. Another concept worth understanding is force majeure. It's a contractual escape hatch used when delivery becomes impossible due to extraordinary circumstances. In commodity markets, it's the equivalent of a supplier saying, we can't get you the material as promised. It's rare, dramatic, and usually preceded by exactly the kind of stress signals we're discussing. Tight credit, extended delays, rising premiums, and strained logistics. Historically, major financial stress has coincided with physical precious metals, markets behaving very differently from their paper counterparts. During the 2008 crisis, credit froze across the system. Premiums on coins jumped even as futures prices were volatile. In 2020, pandemic disruptions and a dash for cash created wild dislocations. In both cases, the issue wasn't geology, it was finance. There's also a structural wrinkle. The precious metals market is layered. You have miners, refiners, large wholesale bars, exchange-traded futures, ETFs, retail coins, and small bars. Stress doesn't hit every layer at the same time or in the same way. It can start in financing, show up in wholesale spreads, then spill into retail availability. By the time small investors notice empty product pages, the pressure has often been building upstream for weeks. None of this guarantees a dramatic outcome tomorrow morning. Markets can heal, credit can loosen, and supply chains can normalize. But when you see falling paper prices alongside tightening physical availability, it's a signal worth paying attention to, not dismissing as a random website glitch. If you're a buyer, the practical takeaway isn't panic, it's awareness. Understand that spot price is a benchmark derived from futures trading, not a promise that you can get coins at that number on demand. In stressed periods, premiums become part of the real price. Liquidity, not just supply and demand in the textbook sense, drives what's actually available. It's also a reminder that modern markets are deeply financialized. Even something as tangible as a silver coin in your hand depends on credit lines, hedging strategies, and bank risk committees you'll never meet. When those invisible gears grind, the effects show up in the most ordinary places, like a checkout page that suddenly says, back ordered. So that uneventful moment when you closed the tab and went on with your day, it might turn out to be one of those small signals that only make sense in hindsight. Not a headline crash, not a dramatic exchange halt, just a subtle sign that the monetary side of the metals market is under strain. And if history is any guide, when finance sneezes, physical markets don't always catch a cold right away, but they do start behaving in ways that confuse anyone who is only watching the ticker. Let us start with a number that should make you sit up straight. A 244% spread between the paper price and the real world price people are actually paying. That's not a premium. That's two different markets wearing the same name tag. When a gap gets that wide, you're not looking at a pricing inefficiency, you're looking at a fracture in the system. In normal conditions, futures prices and physical prices wobble around each other like dance partners. Sometimes one leads, sometimes the other, but they stay on the same floor. A spread this extreme means one of them has left the building. The paper market is still trading contracts as if metal is plentiful and deliverable. The physical market is acting like the shelves are already half empty. Historically, these gaps close when fear cools down and supply lines recover. Dealers restock, logistics smooth out, credit loosens, and the two prices drift back together. The key assumption there is that metal can flow back into the system. That assumption is now under serious pressure because the global flow of physical silver is no longer politically or financially neutral. A major shift has been happening quietly in Asia. Over the last couple of years, China has been pulling large amounts of silver into its domestic system. Not paper exposure, actual bars. Warehouse inventories tied to Chinese exchanges have grown dramatically, while Western exchange inventories have trended the other way. Metal is migrating, and like luggage on a one-way flight, it's not coming back with a souvenir t-shirt. Layer on top of that new export controls. They're not labeled as dramatic bans, but when licenses are required and approvals don't materialize, the practical effect is the same. Metal flows in, not out. That creates a structural tightening in the portion of global supply accessible to Western markets. Prices in different regions start reflecting different realities. So when you see one market valuing silver significantly higher than another, that's not random noise. It's geography, policy, and physical custody reshaping price discovery. Futures exchanges in New York can trade massive volumes of contracts, but contracts don't solder solar panels or plate electrical contacts. Bars do. Now imagine what happens if traders wake up to that disconnect all at once. Futures markets open electronically before most people have finished their Sunday dinners. If bids come in aggressively and there are few willing sellers at old price levels, prices don't politely stair-step higher. They gap, screens jump, stops get skipped. Anyone waiting for a gentle dip gets the financial equivalent of a bus that doesn't T-stop at their corner. At that point, psychology takes over. Retail traders see a big overnight move and pile in. Financial media, which ignored the slow burn stress for months, suddenly discovers a silver story. Commentators who couldn't find a silver chart last week are now explaining it with great confidence. That second wave of attention can push prices even further in the short term. Exchanges have tools for moments like that. Volatility pauses, expanded margin requirements, and trading halts all exist to slow things down. Officially, these measures are about orderly markets. Unofficially, they also prevent leverage from detonating too fast. When prices move violently against large short positions, the losses stack up quickly. Risk managers prefer time over chaos. But here's the catch. Halting or slowing paper trading doesn't magically create physical supply. If industrial users, solar manufacturers, electronics producers, battery supply chains are scrambling to secure real metal, their demand doesn't vanish because a futures contract is paused. It just shifts further into the physical channel, where price becomes secondary to availability. That's the nightmare scenario for anyone late to the party. Not just higher prices, but inaccessibility. a market where you technically own exposure through a financial product, but can't source the underlying material in size. History shows that when governments or exchanges feel systemic stress, access can change faster than rules on a casino floor at closing time.